Tesla's fourth quarter results, they're just crossing the wire. Let's get those numbers. Tesla Q4 adjusted EPS, 50 cents. It looks like consensus was closer to 45 cents. So we got a beat there. Q4 revenue clocking in at $24.90 billion. Estimate was $25.11 billion. Q4 gross margins, there it is, 20.1%. The estimate was 17.1%. Q4 free cash flow, $1.42 billion. The street was closer to $1.59 billion. Let's get your take on this, Adam, because this is another one you own, and the stock's popping about 4%.
Love it, as it should. They beat estimates. Not that I actually care about how many cars they sold, because
why don't you care?
This is a robotics story, Josh. Tesla is already using 10,000 of its humanoid robots, which they call Optimus. Remember C-3PO in Star Wars, right? Oh, Master Luke, right? Literally, the Optimus robot looks exactly like C-3PO, except that it's white instead of gold. And they've got 10,000 in the factories. They are going to be at a 1 million unit run rate, probably 2 years from now. They're going to charge $50,000 per robot. They're going to make net $20,000 per robot. Well, just do the math. 1 million robots, $20,000 of profit per robot. That's $20 billion in profits. Net income. In 2022, the year they sold the most number of cars ever, the profit was $13 billion. Okay, so do the math. In 2 years, they're going to make $20 billion plus the EVs. My point is, they'll make far more money selling these robots than they have ever sold on the EVs. That's why you own Tesla.
I reached out to Cantor's Andre Shepard, who covers the name, likes Tesla.
Yeah.
Humanoid robotics market, here's what he's telling the clients, goes from nearly $3 billion in 2025 to $15 billion by 2030. That would represent a 39% CAGR. We believe this is a material opportunity for Tesla over the long term. So on the call, let's say you could ask Musk about the robots. Would you ask about timeline? Is it fleet size, ASPs? What would you want to know?
Yeah, I want to know the timeline. He has told us that by 2027, 2028, he'll be at a 1 million unit run rate. I'd like him to confirm that. I'd like to see if he could actually do it earlier. There is talk that he will be selling some of the Optimus robots by the end of this year. That would be a big deal because that's sooner than expected. He won't be able to sell 1 million this year, but if he can start selling them this year, that just confirms the thesis. So I'm very happy with Tesla. And again, it's a robot story. It's not an EV story.
So you mentioned the earnings beat there, 50 cents versus 45 adjusted EPS there, beat there, operating income better than expected. Slight miss on the revenue, but still some good updates here from the shareholder deck. Preparations continue in North America for production ramps of Tesla Semi, Cybercab, et cetera, both commencing, and the next generation Roadster, right? So and that includes 6 production lines of new production lines to build some of these new products. What are we talking about here? Optimus robots, right? They said they will unveil the Optimus version 3 in Q1 of this year, which is the production model of Optimus, and that they aim for a production to start at the end of the year with an eventual capacity of 1 million robots, so that's good. Robotaxi stuff, not much there. They mentioned the safety drivers were moved in Austin, but not for all cases. No new regions noted. And also FSD testing in Europe and China commencing, but no approval yet.
So let's say you're on the call, all right? Musk says, all right, over to Praz. You have a question or two for Mr. Musk. What do you ask him? What do you want to know?
I think it's got to be robotaxis, right? So I think that they're saving some of that news for the call. So for instance, more about the safety drivers. When are we going to see more of those taken off the roads in Austin? Secondly, what about the expansion to Arizona and Nevada? Is that going to happen? Is that still on track? Do we have any loose timelines there? Are we going to see potentially 1,000 robotaxis on the road by the end of the year? That's what Morgan Stanley believes. So I think a lot of questions around that business, the most sort of compelling, but also the most immediate business of theirs that's not automotive.
Adam, over to you.
Yeah.
Speaking of all things Musk, my friend, you saw this headline today.
Yeah.
The FT reporting SpaceX weighing a mid-June IPO, aiming to raise as much as $50 billion, valuation of about $1.5 trillion.
That'll make it one of the 20, maybe even more than that, biggest companies in the world. And it's a brand new company, SpaceX.
You excited to own SpaceX?
Everybody's excited about SpaceX. And yes, I will buy it. I'm going to keep it small.
You will buy it.
The valuation is very high.
Yeah.
But if you size it correctly, it's okay. In other words, I'm not going to buy a 10%. I'm not going to put 10% of my money into SpaceX, but I'll put 2. I'll put 2% of capital. I think it's a must-own story, and
How come? Why do you say that, Adam?
Well, because who else is is going to space in this capacity? Who else is launching rockets into space and landing them back on the same pad and reusing that equipment over and over and over again? And where's space going? We don't really know. I mean, it sounds absurd. I feel almost foolish saying this, but right, there's talk of putting data centers in space because it's cold and you don't have to cool them. Space takes care of that for you, and then you just beam the data down. Might that be a business? And yes, it might be. And who is best positioned to do it? SpaceX. Who knows what else is out there for space? So I think you need to be there. I think you need to be part of it.
I mean, you got free energy out in space.
Yeah.
Right. And also, I want to note that
Good point.
It's going to be Gemini and Cancer zodiac signs in June because Musk is seeking that planetary formation and also on his birthday. He's into the stars.
Well, I can't comment about Cancer, but Gemini, the twins. So I don't know where you're going with the twins.
Seth, first of all, just give us your take on this print. We're in the green here. What do you make of it?
Well, I think the market reacted to the strong profitability, adjusted EBITDA, adjusted EPS, free cash flow, all beating consensus estimates. And now we have better visibility on the near-term plans for Robotaxi and Optimus. And so Optimus will enter production in 2026. I think that surprised the market, maybe an accelerated timeline. And we have 7 new cities for Robotaxi expansion in the first half of 2026. It's a loose timeline. I'm hoping to hear more on the call, but all positive things. And we see the stock up after hours reacting to these news.
Now, Adam, let me bring you in here as a Tesla shareholder.
Yeah.
You agree with Seth here? These are the reasons, these are the headlines. We can see this movement in the green.
Yeah, these are the headlines that are driving the stock. But as you know, this is not why I am buying the stock. Yeah, Robotaxi's an immediate catalyst. Fantastic.
It's robots. You're a robot guy.
It's the Optimus robot, and as Praz just mentioned, the company reiterated in the press release that yes, they are on target to produce 1 million of the Optimus robots at some point in the next couple of years, which I interpret as 2027 to 2028. And as I mentioned before, 1 million robots at a profit of 20 million per robot is 20 billion in net income, and that's more than the 13 billion in net income they made in their record year, which was 2022.
Seth, do you share my friend Adam's enthusiasm for these humanoid robots?
Well, I want to hear more from Tesla first about where they're going to use them in their own factories. I know Musk has said he wants to start selling them to consumers by the end of this year. And now anytime Musk makes a bold prediction like that, we do want to give it a few years at least before we think it's going to be set in stone. Yet, if Tesla can find a way to make Optimus robots profitable and helping to make its factories more profitable and useful in a Tesla factory, then they can start selling them to commercial customers, maybe other manufacturing facilities, maybe something like an Amazon warehouse. And if so, then you have a strong commercial outlook for the robots, and then you have a second lever of selling them to consumers down the line. So I am long-term enthusiastic about Optimus, but I want to hear more details about what they're going to do, what their initial capabilities are on the call tonight.
Now, Seth, to Adam's point, which is well taken, there's a lot of Tesla investors. They're not in this company for the EV business. They're in it for the Musk vision. They're in it for the AI opportunities. But on the EV business, team at Canaccord, here's what they say about it. They say Tesla, they say that EV business stands alone, they say, in the U.S. with a truly scaled, integrated EV franchise. In other words, they say EVs in the U.S., Musk is top dog. Do you agree with that? And what is EV demand overall? What do you see for that market going forward, Seth?
Yeah, so Tesla is still the king in the U.S. for EVs. They're the only one that can offer a long-range midsize SUV or sedan at an affordable price that isn't too much greater than the best-selling internal combustion engines in that category. So a Model Y, not too much more expensive than a Honda CR-V or Toyota RAV4 with the new standard prices. And so I think that does make Tesla still the king of the U.S. EVs. But for the first 3 quarters, we're going to be lapping the end of the EV tax credit that ended in September. So I expect EV sales in the US will be down for the first 3 quarters. Now, Tesla might be down by less if it can make a compelling argument for the Model Y by improving its full self-driving software. And so we'll as the year plays out, we'll look for that. But ultimately, I think EV sales and Tesla sales will be down in 2026.
Seth, what about FSD, full self-driving system? You saw this, how Tesla's now saying it will be only available as a subscription. How, as a financial analyst, did you read that? Do you read that opportunity?
I think that was always the plan, was to transition this to a subscription-only basis. And eventually, Elon Musk wants to raise the price once it gets to an unsupervised full self-driving, when it becomes either level 3, level 4, level 5. Either way, when Tesla takes over and as the passenger, we no longer have to be paying attention to the road. We can look at our phones, we can take a nap, read a book, do something else. And I think that's going to unlock a lot of extra profits as they can raise prices with those software like very high gross margins.
Final question, Seth, kind of a bigger long-term question. You know who else is very interested in self-driving cars and robots? Jensen Huang. He is very interested. I have seen some smart folks, Seth, argue NVIDIA is a long-term competitive threat for Tesla. They argue, listen, this is an underappreciated risk for Tesla. And I'm curious, you know the company backwards and forwards. What's your answer to that?
Well, what NVIDIA is going to offer is going to be the ability for an automaker to create an AI self-driving system, but ultimately, you're still going to need to create the software, the system yourself. You're still going to need to train the software. And so we see right now Rivian is trying to do this with their own system, independent of NVIDIA. And so I do think longer term, this can help other automakers develop their own AI software, which doesn't mean they're necessarily going to have to license it for a company like Tesla. But in the meantime, Tesla's going to maintain a very far lead. They're well ahead of the game. Only really Waymo can compare with their autonomous driving software, and Waymo does not offer a consumer version. So I expect Tesla will continue to maintain its lead. And while NVIDIA might be embarking on a real-world AI platform and be a competitor for things like Robotaxi and Optimus, right now Tesla's in the driver's seat. And for auto, I think it will maintain the lead.
Seth, thank you. Appreciate it as always. And Adam, thank you as well, my friend, for joining in all the earnings action and fun.
Thank you.
Meta, just now, releasing its Q4 results. Joining me for the hour as we cover all of this, we've got Adam Johnson, Bullseye American Ingenuity Fund Portfolio Manager. Let's get right to these results. So Meta Q4 EPS, I see $8.88. I don't see a clean compare yet on the bottom line. But Q4 top line revenue, $59.89 billion. Consensus was $58.42 billion. I'm looking for ad revenue. There it is. Q4 ad revenue, $58.14. The street was at $56.79. Turning to the forecast, the Q1 revenue, Meta is giving us a range here of between $53.5 billion to $56.5 billion. The street was at $51.27 billion. That CapEx number, there it is. We're looking for 2026 CapEx. Meta is giving us a range of between 115 to 135 billion. The street was closer to 110.6 billion. Just looking at the immediate reaction here, we're down nearly 3%. Now remember, heading into this print, the stock was basically flat over the past 12 months. It was actually down about 10% since they reported earnings in October. Now bulls will say, and by the way, there's plenty of them. More than 90% of analysts have a buy on this when they'll talk about industry-leading revenue growth. They'll talk about scale advantages, engagement. They will certainly talk about the attractive risk reward. But investors have had these questions about the company's big capital outlays, all the spending here on AI data centers, hiring the pricey AI talent, more questions about where the return is on all that. The initial reaction, we're lower here. I have just the man to talk to about this because, Adam, you own Meta.
I do.
Walk me through why you own it. What do you make of the print?
Oh, you have to own Meta.
You have to own it.
Yeah, you have to.
Why?
Well, you have to own all the core ingenuity companies. Meta, the obvious ones that we always talk about. Meta, Amazon, Google, Tesla. I would add Salesforce.com, ServiceNow, Palo Alto Networks.
Interesting.
These are just core, big, best-in-breed companies that you have to own.
How do you define best in breed? When you're screening best in breed, why does Meta show up?
Well, do you know another social media company that has the reach of Meta? Nobody else reaches 2.2 billion people every day, except arguably Google, but that's different. That's search, and they dominate search. That would be best in breed. Salesforce.com is best in breed, literally #1 for customer relationship management. We could go on and on. Palo Alto Networks for cybersecurity. That's best in breed. Meta is best in breed. What excites me about Meta is that they're monetizing every single aspect of it. And remember, Meta now, WhatsApp, has become the prime B2C, business to customer way of communicating, right? It used to be you'd call a 1-800 number or you'd send an email. Well, now actually all those bots, hi, my name is Susan, how can I help you today? That's all powered through WhatsApp, and they're monetizing it because they're getting paid for it. They're getting paid for absolutely everything they do. They're now selling ads in Reels. So that's a whole new thing that just started last week. So I think you have to own Meta. I really.
But let me
do.
ask you this: how does Zuckerberg?
Yeah.
How does he excite more people like you're excited? Because this stock, as I mentioned, we were down 10% since last time reported.
Yeah.
We're now battling back here.
Yeah, of course
We're actually
we are.
edging higher. But they see things like this. Look at this head. 2026 total expenses 162 to 169 billion. Street was close to 151, and folks are just wondering
they can afford it.
where's all the return on this.
Oh, they can afford it. I mean, this is not an issue. There are very few companies that are able to grow 20 to 30% per year at scale. Meta is one of them. Google's another. Amazon's another. In fact, even higher growth than that. Nvidia is another. That's why these companies trade at the prices they do, both the stock prices and then the valuations. So I'm very comfortable paying 25 to 35 times earnings for a company that's growing 35 to 40% per year. I mean, for perspective, the S&P 500 trades at 22 times earnings, but is only growing at 13% per year, right? So I'd rather pay up to get growth that in some cases is double or triple what the S&P 500 is giving me. And that's why I say you have to own these. And you can't worry about quarterly numbers. I mean, think how absurd that we come here every 12 weeks and say, okay, how are the last 12 weeks? And what are they going to tell us about the next 12 weeks? Imagine if you treated your children like that. You said, all right, kids, I got the report card. So the past 12 weeks are a little rough. How are you going to improve, over the next 12? I mean, really? They'd tell you, Dad, get lost.
Scott, it is always great to see you and to have you on the show. Meta just reported. Get me your take on the print, Scott. We were lower, then we bounced higher. What do you make of it?
Well, expectations for expenses had been rising throughout the quarter, and so I think that set the bar pretty low. Meta's spending a lot of money on CapEx and operating expenses in 26, but there's no real growth story in consumer, that comes near what Meta's doing right now. I mean, the business exceeded expectations in terms of revenue growth by 300 basis points, and then they guided at a midpoint to 30% revenue growth for the first quarter of 2026. So this story from a growth standpoint is very much intact, and I think that flips the narrative to the spending being very much justified.
And all the spending, Scott, when your clients ask you, okay, where's the ROI on all this spend, you tell them what?
The ROI is initially showing up in the revenue growth. When you look at operating profit dollar growth, they will grow operating profit dollars in 26, but Meta's building for the next 10 to 15 years and then reporting revenue on a quarterly basis. So it's one of the very few companies where AI monetization is showing up in real time, in results. And so you have short dated improvements in revenue growth, which should continue, and very long dated spend, which again, I think is on a time horizon of 10 plus years. And so as you get to 27 and 28, I think you'll see leverage again in the business model. And keep in mind, Meta trades at 18 times forward earnings now on a GAAP base. It's a very cheap stock for the growth you're getting.
So Adam, bring you in here as a Meta investor, shareholder, believer.
Meta shareholder.
You agree with what you're hearing from Scott here?
Oh, I completely agree with what Scott's saying. And herein lies the opportunity for investors. There's an arbitrage, naturally, for thoughtful long-term investors like Scott and I, who are taking a long-term view of the company. The company's taking a long-term view of itself. That's why it's making all these investments. And so we come in every 12 weeks and try to make these, we try to game the earnings. We don't. but the market does, trying to game earnings. Did they beat this metric? Did they fall short on that metric? And the stock moves around 3, 4, 5% moment to moment. And as you can see, the stock is now up 4%. It was down 4% as soon as that one number came out where they're spending more on AI than was the estimate. So yeah, Scott's got it absolutely right. This is a long-term story, and Meta is managing the business, not the quarterly earnings.
Scott, I was listening to my buddy Josh Brown's podcast last night. Josh, very smart guy like yourself, Scott. He was talking about Meta, and he kind of framed it like this. I'm just interested to get your take. He kind of suggested, Scott, that Meta has had sort of a story problem, a narrative problem. Because again, the stock is popping here, but heading into the print, Scott, it was down about 10% since they last reported in October. I guess Josh's point was, to paraphrase, they seem to have all these balls in the air, and Zuck has seems to have all these sort of side quests. And he was suggesting, Scott, maybe they would benefit if they were just a bit more clear in their AI story and strategy. And I'm just curious what you make of that.
Well, I think that's a valid point, and I think if you do back up 12 months, and you insert Alphabet in Meta's place and vice versa, the stories were exactly the opposite, and then Alphabet got much cleaner as the year progressed. And I think with Meta, the beauty of that is they have the ability to now provide clarity around the business. They've defined this kind of expense growth. And then I think you'll see the management team talk, quite a bit about the growth prospects of the business. And you're beginning to see, even right now and after hours, the beginnings of a narrative flip again that begins to favor Meta. And Meta trades, this is not a knock on Alphabet, but it now trades at a 6-turn discount on a multiple basis to Alphabet, despite the fact that it's growing almost 800 basis points faster. So Alphabet's margins aren't declining the way that Meta's are, but there's a heck of a lot of growth here.
So let me ask you, Scott, so you're bullish on the name, like Adam, but when clients ask you, Scott, hey, okay, it's a buy, it's an outperform, but what are the risks I need to think about, over the next 12 months? What do you tell them? What should be on their radar?
So outside of macro, so company specific, I think it would be, that the company begins to spend in areas that don't stimulate growth so that you can't see the benefits of it. And so revenue growth decelerates as they're spending. So the core business is perceived as deteriorating, and the company continues to put its foot on the gas in terms of spend. That's clearly not happening right now. In fact, the opposite is happening. Revenue growth is accelerating. But if that flipped, so the core business started to decelerate meaningfully, that would be notable, and it would be problematic for the stock.
Let me ask you, you mentioned Alphabet there, Scott. I'm just curious, any read-throughs from Meta to Alphabet, those earnings on deck, of course?
So the revenue growth healthy, you can't read much in terms of Alphabet's kind of infrastructure, but the vast majority of the business is the advertising, which the advertising industry continues to be strong. I think the primary challenge that Alphabet has is, even though search should beat and the cloud business should beat, the multiple's gone up a lot. Stock's up 60, almost 70% year to date. It's a double off the bottom. And so I think the greatest challenge that Alphabet has now is just valuation, but the underlying business is performing phenomenally well. And I think Meta further validates that on the advertising side.
Scott, as always, we are lucky to have you on the show for that analysis. Thank you, sir.
Thank you, Josh. Appreciate it.
Stock down a swift 6% here.
Yeah, that's right. We actually saw Microsoft beat on the top and bottom line, but the shares are falling, and it's not exactly clear why at this point. They came close to what expectations were for the commercial cloud business, as well as intelligent cloud. We're just in line with expectations for more personal computing. That's where you have the Windows sales, things like that, search revenue, but nothing was too far out of line. It may have been that expectations were higher than what the street originally had, and that because they just came too close to those, we're seeing this pullback in the price. We have to wait for the actual earnings call to get any kind of clear idea as to what CapEx looks like and what capacity constraints are, although they did say that their remaining performance obligations are above $600 billion, and that's basically contracts that Microsoft has that it hasn't been paid out for yet. And so that's revenue to be expected. A lot of that, though, coming from OpenAI. So we have to see more what Satya Nadella says, what Amy Hood says on the earnings call in a little bit.
All right, Dan, thank you. Appreciate that instant breakdown, my friend. Kimberly, the results cross. Initially here, we are in the red. What do you make of the print and the reaction?
Sure. Well, I think people are really concerned of, is Microsoft going to be part of AI in the future? And what represents that for them is Azure. Are people buying access to Azure? And it was a little bit of a disappointment. And I think even that little bit of a disappointment can throw at least investors who trade after hours into just dumping the stock, right? And that's what you get with, well, I mean, it's only down 4.5%, but that's still kind of, throwing the baby out with the bathwater, maybe.
One question from Microsoft, Kim, is, obviously this is a company, the roots are in software, right? That's its history. And
right.
There is this sense out there, and this, investors, they just think AI is the death of software. I mean, they won't go near those software stocks. And I'm just wondering, how, as a longtime watcher of Microsoft, how do you think that software business navigates, Kim, this new AI future?
Sure. Well, I think people really are leery of things like Salesforce that have been growing because they've been adding functionality. And now people think, well, you could just, use Claude and write whatever you want. Well, as an ex-software engineer, good luck with that. I think it can help people write code, but I'm always kind of skeptical about that. But the real driver is this: where's the data? Where does it live? And for most businesses, it lives in some sort of Microsoft product. It could be Word, it could be Excel, or it could be their database. But Microsoft will get paid because we need access to that data. And that's how we make data. We use those products to store it. And I don't think anybody's going to want to rewrite like a data repository. So those core Microsoft Office 365 revenues are probably safe. And I just don't think that vibe coding for enterprise is going to be a thing.
On Azure, Kim, we know the company's been dealing with these capacity constraints, so hey, they're going to invest a lot in capital expenditures. Do we have any sense of when those constraints might ease, Kim?
No, we don't really. I think everybody is asking that question, and in fact, I just saw Lam Research kind of pass by. So I think that people are continuing to spend, right? The designers and the makers of semis are buying Lam Research. Everybody and their brother is expecting for more spend on just the basics. So it really is up in the air.
We've been talking, Kim, about AI and the cloud. What also, Kim, about the PC market, the gaming market? I'm curious how you see those markets evolving 2026 and what that means for Microsoft.
Sure. Well, it really is kind of a back seat for them, although they are huge businesses in and of themselves. Now, in 2025, we had the benefit of Windows 10 being, taken or no longer supported. So that did drive some sales of PCs. But I think it's going to be kind of a lackluster, maybe 18 months for the PC for a couple of reasons. Really expensive DRAM and memory is probably going to chill people who are kind of marginally thinking about upgrading. But then also, I think that just the people who upgraded recently are probably got pulled through because they had really old PCs with Windows 10 on it. So that probably pulled a lot of things forward. And gaming, it's so small part of Microsoft, I don't even look at it, sorry.
No apologies necessary, Kim. I'll get you out on this. This week, Microsoft also unveiled the second generation of its in-house processors. My colleague Dan Halley was writing about that. How should investors, Kim, interpret that news?
Well, I think it's a really broader look at AI in itself, that maybe people who think NVIDIA won, you could take that off the table. Amazon has their own chip, Microsoft has their own chip, Google's going to have their own chip. Everybody's going to have a flavor that makes their tech stack work best. And I think that's great because it makes NVIDIA, who is the leader, make better products. Isn't that what we all want if you're a capitalist, is a good market with everybody trying to outperform each other? I say yes.
Kim, appreciate that instant analysis. Thank you so much.
Thank you.